Welcome to Catalysts. I'm Brad Smith. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts we're watching this hour. First up, we break down the market outlook for the second half of the year as traders brace for volatility. Plus, we'll bring you the latest on the escalating situation in the Middle East and why investors are looking to safe havens. And American Airlines and United pausing Mideast flights amid the Israel-Iran conflict. We'll discuss that and much more on Catalysts. Let's get to it. Half an hour into the start of the U.S. trading day. Let's get a check of the markets here as we're taking a look at the major averages. We've got green across the screen here. Fractional gains as they may be, we're up by about 0.3% for the Dow, the S&P 500, and the NASDAQ. Let's flip on over to the bond market as well here, taking a look at the 5, the 10, and the 30-year yield. We've got some movement to the upside here. Fractional gains there on a percentage basis here for the 5, the 10, and the 30-year. And then additionally, looking at Bitcoin. Take a look. We are at $105,000 as of right now. We've been tracking this really closely over the course of the past few weeks as any semblance of being able to stabilize above 100,000 might add even more of that longer term bullish sentiment, and we'll see what type of purchases are also announced as well. You've got everybody from strategy to even GameStop now throwing their hat into the rings and some new whales out there. So we'll continue to watch that. Bitcoin sitting just below $106,000. Well, coming into this week, investors were awaiting commentary from Fed Chair Powell and a potential decision from President Trump on whether to take military action in the Middle East. I want to bring in my contributor for the hour, Jeremy Schwartz, WisdomTree Global Chief Investment Officer. Jeremy, good to have you here in studio with us. You say geopolitics are taking center stage in 2025 when it comes to the markets. How does that play into the portfolio rotation that you're conducting right now?
Yeah, the Fed was one of the stories of the week, and we could sort of say it's yesterday's story. There is some drama at the Fed, and you've got Trump really attacking Powell, calling him too late Powell, and there's many things on that we agree that they should be like about 100 basis points lower. So there's an element of we think he's right, but Powell's been stubborn. Now it's interesting today, you've got Chris Waller out saying they could be cutting in July, so maybe he's auditioning for Powell replacement is what's going around social media. But we do think geopolitics is number one story. Tariffs are a big story. All the conflicts, clearly, you see that front and center with the Iran story. We think it's that is one that we think is not a major risk for markets now. We think it's trending in a better direction. The market's sort of comfortable with where it's heading.
Interesting.
But Europe with Ukraine, Russia, is a sort of an extended conflict. You've got Asia. That's a potential long-term, maybe a short-term risk.
Sure.
So that is the number one thing we're focused on as we look at portfolios.
What is the risk that the conflict actually disrupts progress on the tariff and trade talk side as well, given the timing of how this is all coming together?
Well, July 9th is his important day where that's like when tariff deadlines come back around. Now, he's also shown if people are willing to negotiate, they extend. So China has got things pushed back 6 months. They had the UK London summit, and he wanted things on rare earth exports, these magnets that they were sort of prohibiting and restricting from coming here, and they got what they wanted on that to ramp it up, but it was really only a 6-month time frame for, and that's the hardest of all the trading partners. Everybody has 10% baseline, and China has 30% with this extra fentanyl tariff. That's the hardest one. So if he's willing to pause 6 months for China, if everybody else is negotiating, you could see them extending, but you'll have a lot of headlines until July 9th, and we'll see where it goes.
Is that making it any more clear what this long-term tariff rate might look like, and how are you thinking through that?
Well, I think there's a headline, and I forget where I saw it quoted this week, but somebody saying Europe might be looking to do the same 10% deal that UK did.
Interesting.
And if that's like the baseline, we've said the market's got uncomfortable with 10% baseline, 30% for China. And anything that lowers that is very positive for the market. So it's comfortable with the 10-30 framework. They've been talking about these deals, and Hassett has said, hey, got 3 deals ready to sign, but nobody's signed, a framework agreement again. We thought Japan would be there. We thought Korea, Taiwan. There's a bunch that have been sort of, we thought advanced, and they're still I guess, getting the final details of what this frameworks will look like.
We were told that they were just 2 weeks away, 2 months ago.
Yes.
And so now with the absence of those deals, how are you seeing businesses posture themselves for some of the uncertainty that could continue to impact how they operate longer term?
Yeah, I mean, there's been this long-term trend of manufacturing not being in the U.S. So a lot of it, Trump wants to bring manufacturing back, and there's
But
stories.
that would affect the cost of goods, essentially.
Yeah, and part of what we were saying is that it's sort of inevitable in some ways. Like it's not happening. As much as he wants to bring a lot of stuff back, there's a much longer-term powerful force of just of where things are going. That's not been tariffs or not. It's not going to bring a huge surge, but there are investments coming. You even see this morning, Masa's son was quoted of wanting to build $1 trillion AI robot in Arizona. So there are things of investment coming back to the U.S., and that's all in the right direction. But some of it still doesn't make sense in terms of where it's going to come back to the U.S.
Jeremy, stay with us. We've got much more to discuss throughout the hour. Now time for some of today's trending tickers. We are watching Circle, Accenture, and Stellantis. First up, Circle extending gains. The stablecoin issuer up more than 500% since its IPO earlier this month. This after the Senate passed the Genius Act this week, and the legislation would establish a regulatory framework for stablecoins. The bill now heads to the House. You know, as we're taking a look at shares of Circle up right now by about 12.5%, I wonder how you're evaluating the crypto landscape more broadly, especially now with this interest that's very clear, whether that be from stablecoin issuer Circle or whether that be from the largest bank in the US, in JP Morgan, that is now looking across, okay, where can our efforts move forward with a digital currency and a stablecoin essential? Right?
So WisdomTree has a lot of thoughts on this because we're in the game. So
yes,
we have a tokenized platform. We have our own wallet, WisdomTree Prime, where we have 13 different tokens. We have a debit card tied to a money market fund. Wow. So our money market fund's earning 4.5% almost, and you could make payments with that. Okay, so that is disruptive to a JP Morgan and the banks, because even Circle, who's getting the interest on all your stablecoin assets? Circle is. You're not getting your USDC payments. They're taking your cash, buying treasuries, they keep it. Our money market fund, we pay out 4%. And so that is a version. It's not a stablecoin as they refer to it, but it has the stable dollar, and you can tie it to your payments with our debit card. So it's a very interesting dynamic, and it goes back to Tether, right? They take your cash in Tether.
Right.
They take all the interest, and with all their little employees, they're making so much money because they're keeping all your treasury income. So I think it's part of the rise of Bitcoin was in this payments world that the financial system, the banking system, why is it 9 to 5, 5 days a week? 24/7 is what Bitcoin promises, but the payments architecture needs to change, and that is what the blockchain is all about.
That's a great point. Great insight as well here. We're also tracking Accenture this morning. Accenture topped third quarter expectations and raised its full year revenue outlook. Still, the consulting giant reported a second straight drop in quarterly new bookings. That's weighing on the stock here. As you can see, shares down by about 7%. The company also announcing a new unit to boost its AI consulting services here. You know, as we're taking a look at the share price action over the course of this year as well, I've got it pulled up here on my screen. I'm taking a look at shares year to date, down by about 18.5%. So really hasn't participated in this rally back to the ballpark of highs. And you got to wonder for Accenture and what they're hearing from businesses that they consult with, how many of those businesses are really just trying to look across their expense base and saying, okay, some of these larger contracts on consultant fees alone, we even need to come down on a little bit right now.
Well, that there's a lot of memes going around about like the McKinseys and the consultants of the world.
Oh my gosh,
about,
yes.
Like you get your AI interns, and do you really need these $300,000 McKinsey contracts or hundreds of thousands of McKinsey contracts? So I think some of that consulting world is facing that AI disruption, and there's also the government spending cutbacks as well. So it's being disrupted in a few different places, and I think that's some of what you're seeing there.
Absolutely. Finally here, let's talk Stellantis and go where the vehicles go. Stellantis considering a possible sale of its luxury Maserati unit. This is according to a report from Reuters, and this comes after Stellantis hired consultant McKinsey to advise on the effects of tariffs on its Maserati and Alfa Romeo brands. Possible divestment of Maserati is reportedly among the options being considered, but a Stellantis spokesperson saying, quote, respectfully, Maserati is not for sale, end quote. Maserati sales fell more than half in 2024 here. So you summoned McKinsey into the conversation.
I promise that wasn't planned.
But here's the thing. As we think about some of these super luxury ends of the vehicle market, and of course there was always within crypto the Win Lambo conversation. Well, for Maserati and the client base that they go after, this is custom vehicles largely that we're talking about, and ultra high net worth individuals that are looking at other assets that they can lean into right now versus some of these super luxury automotive spends. And it seems like that's been apparent in the first half of this year as we've seen some of those money flows move around into other services or real property versus some of the luxury vehicle market right now.
I mean, global autos have come under a lot of pressure for many different reasons. They are part of the tariff story. Mm-hmm. China's autos have been on the rise. We're like the only country that doesn't really, in a way, we're prohibiting really the China autos. The only car company with a very good multiple is Tesla. But you could argue it's definitely not about the cars. It's about self-driving. It's about his story on humanoids, their AI play. So they're the only one who gets a nice multiple, and everybody else is under a lot of pressure from a lot of different forces.
Yeah, I think I was reading a report from EY Parthenon last week, or earlier this week actually, that was talking about how we could essentially see some of the larger deal making that was anticipated coming into this year really come in the form of deals like this, which is strategic divestitures and finding a potential suitor to purchase that asset. And in this case, Maserati, I believe it would find value in anybody's garage and then also in somebody else's portfolio if we were to see that sale go through. Excellent breakdown of some of these tickers here. You can also scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, could gold's 2025 breakout become its biggest of all time? Well, guess what? We're going to break down what the data tells us after the break.
Gold is on a tear in 25, up nearly 30% so far this year, torching stocks and bonds as investors scramble for a safe haven, watching the dollar head lower. I'm Jared Blikre, host of Stocks in Translation. We're going to start here with a century of gold in a second here, but I wanted to find the gold standard. And this is something that went away 90 years ago. The gold standard is a monetary system where dollars can be swapped for a fixed amount of gold. And here's that chart. Way back in the day, you go back to 1920s, you used to be able to swap in your gold for $20.57 per ounce. But that came to an end right here in 1934. That's when FDR ended gold convertibility, also made it illegal to hold gold, and basically stayed at this price for a long time. You'd have to get to Nixon in 1971. That was when he closed the gold window and we had the era of free-floating currencies. So this was beginning of the foreign exchange era. And then we saw a quick rise, about 350% in the price of gold into the 1980s. But that was when Volcker raised interest rates all the way to about 20%. And that caused a peak in gold that would not be seen for decades. Now, 4 is when we had 9/11. That was late 2001. We also had China joining the WTO, which meant that it was going to be consuming a lot of metals. And so we saw a rise from here into this QE area. Number 5 is when Ben Bernanke at the Federal Reserve basically said QE forever and also lowered interest rates to near zero. So that was the beginning of the zero interest rate policy era. Now in 6, we saw a peak of gold in about 2012 with China. Then we had a dip into 7. That was the beginning of negative interest rate policy. So no ZIRP, NERP that we saw in Switzerland and Japan. And gold ended up tracing out this very big cup pattern into 8. That was the beginning of the pandemic. And of course, then we had huge stimulus and we had a little bit of a handle here. And then by the time gold broke out into the 9, that was 2022, 2023. We saw a bit of consolidation when we had that big period of twin deficits really in the public consciousness. But with Trump 2.0 and tariffs, we have taken off yet again, and we have hit $3,500 per ounce, and that leads us to where we are today. Now, here in this chart, I have 2 of the biggest gold breakouts of all time. That would be 1972 and 2005, and also 2025. That's in white right here. You can see we're just getting started. But the really interesting line is 1972, and as I was saying before, that's when Nixon ended the gold convertibility for four nations, and that was the beginning of the Forex era. That was basically the breakout of a 110-year base, and we saw significant price appreciation for the next couple decades after that, or at least next decade after that. So I guess the bottom line here, I think that we're seeing gold in the early innings based on the size of some of these historical breakouts. So we'll have to see what comes of that. But as Ralph Alcampora, CMT, also known as the godfather of technical analysis, has said, the bigger the base, the higher in space. So we'll have to see what that means for gold prices. All right, also stick around for the next episode of Stocks in Translation. New episodes drop every Tuesday and Thursday right here on Yahoo Finance. So get them wherever you get your podcasts and on our website as well. And back to you, Brad.
Thanks so much, Jared. Appreciate it. Still with me for the hour, we've got Jeremy Schwartz, WisdomTree Global Chief Investment Officer. Jeremy, so as we're thinking about and transitioning from what we were talking about a moment ago in digital gold to real gold, how does this kind of sit within the portfolio thesis, knowing how far we've run over the course of this year and where we could see some topside pressure?
You know, I was just looking online at very interesting, he talked a lot about technicals.
Yeah.
And, you know, that there was a question, it's not like a company where you have earnings to value, but there is a group that has what they call the fundamental price of gold, a group called Correlation Economics, and they put out a price target of 3,800 based on what they see trends in basically interest rates, curves, traders, the dollar. So there are a bunch of they have 5 different inputs, and they put out 3,800. It's, you know, I think that the challenge for investors is, you know, you have your people talk about the 60-40, so the standard 60-40 stock bonds, and that's what the default allocation is for a lot of people. If you're to add gold, what do you fund it from? And that's one of the biggest challenges. We tried to solve that very interestingly 3 years ago. We launched an ETF called GDE, so G for gold, GDE. Yeah. But it basically takes an S&P-like experience of 500 largest stocks, our own index, and then adds gold futures on top.
Okay.
And that fund has been the top performing large blend fund over the last 3 years of all the funds, like 1,000 plus funds. So, and it's a simple idea. Get you some gold, get you the broad equity markets, but package it in a novel way. And so the idea is you don't have to sell your stocks to buy gold, is that you can just add it on top of a broad equity portfolio.
You know, we got to go to break, but I just very briefly wonder, with some of those very bullish outlooks that you've heard on the street, how much of that is also based around some of the international buyers continuing at the same pace that they have been buying into gold?
Yeah, the central banks. Basically, it's like China saying, I don't want your treasuries, I'll take gold. Yeah. That's more or less the story, is that people are worried. They saw what happened to Russia and where we confiscated all their reserves, and they said we need to get some hard assets, and I think gold is fitting that bill, and so all the central banks around the world are doing that.
Absolutely. All right, thank you. We're going to pause there for a hot second here. We've got to switch gears as we're tracking another major story here today. American Airlines and United Airlines have temporarily suspended flights from the U.S. to certain regions in the Middle East amid geopolitical rising tensions. American temporarily halting its daily flight to the capital city of Qatar through June 22nd following a security alert. Meanwhile, United is pausing daily service from Newark to Dubai. Joining us now, we've got good friend of the show, Stephen Trent, who is the Citi America's Airlines Analyst and Managing Director. Steve, good to see you here this morning, and thanks for taking some time. Just first, take us into your analysis. I know that both of these companies, for United and American, they do this through their code sharing and those alliances that they've been able to generate over recent years. So all this in mind, how long of a pause could potentially start to affect what we see when they report earnings in several weeks' time?
Yeah, good morning, and thanks for having me on. So certainly, I don't want to downplay the seriousness of what's going on, because it is certainly serious. But when one looks at United and American, for example, Middle East is a relatively small piece of the pie. In United's case, for example, it's mostly Tel Aviv, for instance, and its overall Middle East exposure is somewhere less than 2% of capacity on a global level. American Airlines, it's even smaller. But you have had over a couple of years this issue. So since the Ukraine invasion, for example, it's virtually impossible for them to fly over Russian airspace. You now have some additional complexity to this flying. So I think at this early juncture, it's small enough and they have enough flexibility that they can mostly mitigate the issue. It would be good to see this capacity switch, per se, be somewhat limited, and too early to say how long it's going to last, unfortunately.
I wonder if there's been a spillover into just summer international demand, and knowing that people tend to book these trips months, if not years in advance sometimes. Is there any skittishness that we're seeing in bookings from consumers who are looking across some of their international flights, or perhaps even pausing some of their itineraries?
Yeah, great question. So we haven't seen that so far. We do keep our eyes on, of course, what's happening internationally. That has been the stronger piece of the pie for the group. When one looks at, for example, premium cabin versus domestic main cabin versus international long haul. That's been a good area. And for these airlines, the vast majority of the international has a U.S. point of sale. So relatively wealthy consumers are still going. I would say post-pandemic, the summer travel season to Europe has extended into the autumn. So it's not necessarily as concentrated around July and August as it used to be. But certainly, if we see skittishness from that group of consumers, that's absolutely something to watch. Whether it's nervousness about going to the Middle East, or whether you're going to get attacked with a squirt gun on some European tour site, these are the kind of things we definitely want to keep our eyes on.
While we have you as well, I got to get your take on the Paris Air Show, because we already know that there was both pullout from Boeing's presence, or at least a downgrading in that specific presence from Boeing, especially following the Air India flight. And then additionally, of course, you have some of the spat that was taking place regarding the representatives that were going to be there from certain Middle East regions as well. How does this year's event just compare to years past, and the anticipations versus what actually transpired?
Yeah, absolutely. So, I think certainly it was very unusual this year on several levels. I don't think I ever recall any air show where there was a major fatal accident that coincided with the start of the event. So that's, was a really terrible and somber thing that happened over in Gujarat. I think overall, though, certainly looking at the space, the aerospace side of the fence is a touch outside my wheelhouse. But what I will say is definitely over the past couple of years, commercial aero has been trying to find its footing. Supply chain delays, and we've had some issues with respect to product quality. So I guess from a personal level, it's not a complete surprise to see some entities downgrade their presence.
All right, Steve, I know we're up against a hard timing restriction here. We appreciate you hopping on with us. Thank you.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Catalyst. CarMax rising after topping first quarter expectations, with sales rising nearly 6% from a year earlier, boosted by strong demand for used vehicles. Joining me now, we've got Scott Devitt, who is the Wedbush Securities Managing Director of Equity Research. Great to have you here with us. So you have an outperform rating and a $90 price target on the stock. How are you looking at CarMax right now?
I thought it was a good quarter. Retail units were up 9%. It was a record high gross profit dollar per unit. So it was a good quarter. This company is constantly playing catch up with Carvana. And I think Carvana is making it a better company, but it's a slow progression, and they've shown some signs here of strength. I think the asset long term is mispriced favorably, but it's kind of a steady as she goes, and they have to keep executing.
We're continuing to look across this gross profit, and I wonder your evaluation of their gross profit. And it did increase by 13%, in the most recent quarter, driven by higher unit volumes, strong unit margin performance here. But so much of this business is making sure that when they are purchasing cars as well, that they're purchasing cars that are favorable enough for them to then be able to flip and add on that margin. What's your own assessment of the margin run rate that they're going to be able to achieve over time here and grow to even get more shareholder value returned?
So what's happened in the past 12 months is that retail prices have been rising faster than wholesale prices, which is good for a retailer like CarMax because they capture that spread. I think what you're going to see potentially over the next 12 months is that that gap tightening a little bit, which will be somewhat of a headwind. But from a sourcing standpoint and a scale standpoint, it's really kind of a two-player game. 90% of this industry is sold by small mom and pop still. And CarMax and particularly Carvana, are consolidating the industry at the kind of head of the industry. What's notable, is within the next 3 years that Carvana is going to start to approach and potentially exceed CarMax units. So that'll be important to watch. I think both companies can win, but there's one, performing at an A+ level, and that's Carvana. And I think, CarMax is probably a BB+ right now, and the rest of the industry is a C.
One of these stats from Tesla's first quarter earnings call jumped out at me for this conversation because Elon Musk had said a passenger car typically has only about 10 hours of utility per week out of 168 Pi, very small percentage here. And once that car is autonomous, his rough estimate is that it is in use for at least a third of the hours per week. So 50, maybe 55 hours of the week. The reason I bring that up is because you have one very clear goal at Tesla to make sure that there are more robo-taxis or more full self-driving, which would mean less people might need to purchase a used car from CarMax or Carvana. So what is the headwind risk there if we do see more of the consumer mindset shift towards an option that is more full self-driving or is more, cyber taxi or cyber cab, especially as that's being rolled out this weekend?
It's a great point. It's a very long duration kind of discussion. I mean, this is going to take years to play out. But I think one thing that I would say is that if used car sales, become more challenged, more of the industry will consolidate among the leaders. That'll be a positive for Carvana and CarMax. Tesla's starting out kind of baby steps. There'll be an employee sitting in the passenger seat. So, it's going to take quite some time. But it's definitely something that we pay attention to because you're definitely correct in terms of the ability. If Tesla is successful, if Waymo's successful, the ability to utilize, particularly Tesla, as it relates to an individual's vehicle, that a higher level of utilization of the vehicle means less of a need for cars, which could have an impact on overall unit sales.
What does that also mean in terms of some of the fleets, the autonomous driving fleets for the major ride-hailing companies, Uber and Lyft? I believe those are also as part of your universe. Sure.
I think that is rideshare would be in the crosshairs first because I think that the consensus view among investors now, because it's been promoted quite aggressively by Uber, is that autonomous is good for a company like Uber. We think quite the opposite. We think that as supply does concentrate among a smaller number of vendors, as autonomous becomes more prominent, more of the control shifts and the power shifts to the vendor and not the marketplace. And so this is a debate that's going to grow over time. You brought it up as it relates to used car sales, and I think it's very, very valid. I think the first, kind of area to pass, or the first set of companies in the crosshairs, is going to be Uber and Lyft, and that's only going to start to grow, starting on Sunday.
Scott, while we have you, my guest contributor for the hour, Jeremy, is here with me from WisdomTree, and he has a question for you as well.
Yes, Scott, one of the really interesting stories we saw earlier this year was when GM announced a partnership with NVIDIA. You think about where these self-driving tech is going. Some of these car companies need a partner, like a big tech company. We see Tesla competing. Do you see any other big tech companies getting around? Are you excited as we were on the NVIDIA news, or is that just too early to know what's going to be?
Well, I think NVIDIA as a company is just well positioned across a lot of areas of AI, if you will, including autonomous vehicles. The challenge that traditional auto manufacturers have, is it's a very typical kind of innovator's dilemma. One, those businesses aren't naturally run perfectly to begin with, and two, they react pretty slowly. So to think that, anyone on the traditional side is going to be able to replicate what Tesla's doing, I think is a bit far-fetched. So a relationship or connectivity between, a GM and an NVIDIA, I'd be a little skeptical of. But I think what's very powerful and quite an opportunity for Tesla is in the ability to kind of license out their technology to vendors over time, which, as the Tesla technology proves that it can work and scale, becomes a huge opportunity for that company.
Scott, thanks so much for taking the time here with us today. Really appreciate it.
Thanks so much.
We've got all your markets action ahead. Stay tuned. You're watching Catalyst. Meta is on a hiring spree in a bid to beef up its artificial intelligence operations. The company is doling out billions of dollars. The latest reporting says the social giant is hiring former GitHub CEO Nat Friedman and Daniel Gross, the CEO of Safe Superintelligence, which was founded by an alum of OpenAI. The reports come just 1 week after Meta invested $14.3 billion into Scale AI and hired its CEO, Alexander Wang. Joining us now, we've got Dan Howley. Dan, what do we know about this aggressive strategy here for Meta to really bolster its AI operations?
Yeah, Brad, this is all about the kind of war for talent, ensuring that Meta has the highest level of researchers and just people who are in the know in the AI space as possible. So Daniel Gross, obviously, he co-founded Super Safe Intelligence with Ila Stutzkever, who also, by the way, co-founded OpenAI. He also was part of AlexNet. That's Ilya. That was basically the thing that helped kick off all of the AI model kind of growth out. And this guy is prolific. They wanted to originally, according to these reports, buy Safe Superintelligence, but they were rebuffed. And so Meta then went after Gross to bring him on board. He's doing that as well as Nat Friedman. And he's investing, or they're investing, Meta that is, in their own their own portfolio of AI companies. And so this is, again, just a bigger part of what we're seeing across the tech space and AI, where companies are going out trying to invest in, if not invest in, then hire some of the biggest names that they can find so that they have the most cutting edge models available. And for Meta, it's part of, one company that's pouring billions of dollars into this. Meta's not happy with the state of its Llama 4 models right now. They're not the only ones that are pouring billions of dollars. Microsoft, OpenAI, though that relationship is reportedly souring. Microsoft and OpenAI, though, say that that's not true. You also have Amazon pouring billions and billions in with their own chips. And you have Google with its own investments that are going on. They have Google DeepMind. They've been moving around some of their pieces there. So, it really is kind of a race to the top to see who can hire who and at what point they'll be able to kind of take the crown from essentially OpenAI still at this point. But with these investments, Meta clearly trying to say, look, we're not going to sit back. We're not going to sit by. We have the capabilities. We have the war chest. And we're going to go out there and we're going to try to hire whoever we can to try to dethrone OpenAI.
Dan, thanks so much for tracking all of the developments and the investments. We're going to continue this conversation in a hot moment. Thanks. This month, Reddit sued AI giant Anthropic, claiming that the OpenAI rival had accessed its platform of more than 100,000 times. It accessed the platform since July of 2022 after Anthropic allegedly said it had blocked its bots from doing so. We sat down with the COO of Reddit to discuss the suit.
What's important to us is that that we are able to protect our users' privacy, their deletion rights. Like, we have policies that ensure that, when users take down a post, like the post is taken down. And so it's really important, and as we said in our terms of service, that, we have a conversation with folks who have access to our data, because that's a commitment that we have in terms of our policies.
Our next guest has crunched the numbers on the size and scope of AI scraping by bots and helps publishers profit from the scraping. Joining us now, we've got Toshit Panigrahi, who is the TollBit CEO and co-founder. TollBit is a New York-based startup that helps news publishers monitor and make money when AI companies scrape their content by acting almost like a toll booth of the internet. Did we get that right, Toshit?
Yes, that's correct. Thanks for having me.
Absolutely. So take us into your business and what you're seeing more broadly here, especially as we're knowing and knowledgeable of how much scraping these AI engines need to do in order to get either knowledge sets that can then be used for generative AI efforts, and they reach to basically every source part of the web that they can essentially get their hands on for free.
Absolutely. So TollBit is a platform that helps websites of all sizes monitor, manage, and monetize their AI bot traffic, which essentially means we give them tools to get an idea of how rampant the scraping might be on their site. We give them tools to block it and enforce the content access rights. And then we give them, I think a real innovation is our bot paywall, a tool that allows these AI bots to come in and actually pay for sanctioned access to that content and data, right? And I think one of the things that we're seeing, right, especially in the last quarter, is the demand for not for content for training, content for retrieval at inference time. When people ask a question, the bots have to go out and read and answer your question.
Is AI training, as it stands right now, ethical from the standard practices that users expect when they're on the internet?
I think this is a question that's bigger than all of us. I think we're definitely looking to some of the courts to decide and set some precedent as to whether or not training is fair use. But I think us as a business, right, and I think where some of the conversation should be going should be around, these bots who have to go out when you and I ask a question on any of these platforms to go read that content, right? They don't know what happened today. They don't know what the price of a ticket was if you wanted to go to France, right? They actually have to go out and access those sites to get that information. That will be a far bigger use case than just training as these tools continue to evolve.
And so what is the revenue model like? How does the business make money?
So essentially with the technology that we've built, we have built a gateway that any AI application, agent, bot can come in through and actually pay through the form of micropayments for access to content and data, right? So it could be anything from what happened today, right? You want to read what happened on the news today, to I want to know, what the price of a hotel is today in New York, and I want you to go book it for me, right? And so we are able to let the website set those rules, set the access protocols for what that content data should cost, and then we take a transaction fee on top of that for enabling this faster, cleaner, licensed access to the content data.
Toshit, really fascinating business, and I'm sure there's a very large total addressable market that just continues to grow at this juncture. Thanks so much for breaking this down. We appreciate it.
Thank you.
Still with me for the hour, we've got Jeremy Schwartz, WisdomTree Global Chief Investment Officer here, and you and I were talking in the break about one of the more interesting AI plays, if we can call it that, I suppose, based upon what you've been able to dig and look at under the hood with Kroger.
Yeah, I was watching your segment right before the show, and I said, well, we own that in our AI fund, and we own it in our value fund, so it's a very interesting combination of that. And the idea was, they have customer loyalty programs, like 60 million customer accounts. And what is AI? It's you take in all sorts of data and you get insights, and they sort of formed a division called 8451 that's sort of retail data science, trying to get the best insights of all this data and are using it very creatively. And so we thought it was a hidden play from this 8451 unit and how they're being a leader in innovating. And as one of the top 25 largest revenue companies in the US, they have a lot of transactions that go through their system, and they're able to share insights with the retail industry. So it's definitely, in our view, both a value and an AI play, and also why you don't just have to buy the Mag 7 to be tech. There's these other companies that are going to learn how to benefit from the technology, and Kroger is a beautiful use case of that.
Sounds like a major asset for the company here. Thank you for breaking that down for us. Also coming up on the other side of this short break, planning for retirement amid current volatility means retirees are facing risks they may not be prepared for. We want to help you get prepared. That's next. Investors have enjoyed back-to-back years of double-digit returns from the S&P 500, but trade uncertainty, geopolitical conflict, and inflation could potentially weigh on portfolios. Our next guest says there are 3 risks investors near retirement should be aware of. I want to bring in John Shrewsbury, who is the GenWealth Financial Advisors co-owner and managing principal for this week's FA Corner, brought to you by Capital Group. Great to have you here with us. So let's just dive into where some of those who are near retirement should be monitoring in the range of different items that could impact some of the returns for their hard-earned nest egg at this point?
Brad, obviously times like these are scary for people as they approach retirement. When you think about what retirement really means, it means that you're kind of walking off the paycheck cliff and depending on your own resources to do that. And your resources are being bopped around by the market volatility that is being prompted by the uncertainty in the Middle East. So you've got a situation here where people are also facing risk that they don't really even appreciate, I think. Number one is inflation risk, because in working years, your job usually keeps pace with inflation in terms of pay increases. When you go into retirement, prices still go up, but you have to increase your income from your portfolio. So your portfolio has to support those income increases that you would get in retirement. Longevity risk is another issue. If you think about the risk of living too long, and I know that sounds funny because we all want to live a long life, but longevity kind of stretches your portfolio and causes you an undue strain. The longer you live, the more your portfolio has to work to provide that income. But the big risk that we see that kind of combines with what's going on right now is timing risk, or what we would call sequence risk, sequence of return risk. Imagine this: as you're walking into retirement, all of a sudden your portfolio drops pretty significantly, and you're forced to sell things at a time when you probably don't want to sell them. That is sequence risk. So those are the three big risks that we see in retirement. And I think people oftentimes think they have to be tactical to address those risks, but you really have to be strategy-based, and that's what we would prescribe as a proper strategy to navigate around that market volatility.
Amid the confluence of these events, how can those near retirement effectively de-risk to make sure that they are kind of navigating with their own investments and portfolio, navigating in a sense that will continue to grow their money regardless of how volatile things get?
I think number one, you've got to focus on the next 5 years and then isolate a portion of your portfolio into less risky investments so that you're not reverse dollar cost averaging, or you're not selling things when the market is volatile. If you isolate that and go into cash and cash equivalents, low risk bonds, things of that nature, then you've got a pool of calm money that will get you through most of the upheavals that you see in the market. And then if you kind of stair step your portfolio in time segmented buckets, if you will, more of a balanced approach after that 5-year period of time, and then after 10 or 15 years, you can go into equities because you're going to need that growth. And I think the real magic of this is to harvest gains from those equity buckets and those balance buckets and refill your income bucket as time goes on. And you have the opportunity to do that when markets settle down and performance is better than it might be during a downturn.
And what about for the part of your portfolio where you still do want to have exposure to risk? Are there new opportunities that you're seeing really make themselves clear at this point?
There's always a lot of opportunities to stabilize risk. There's obviously, options that you can take on your equity portfolios. There's also a means by which a indexed annuity can downside risk protect, but still give you upside potential. Registered index-linked annuities have the opportunity of getting most of the upside of the market, but also can buffer the downside. And for folks where that's appropriate for them, then that could certainly be a way that they could have a little bit more sleeping power when it comes to those equity portfolios against the backdrop of a volatile market.
John, thank you so much for taking the time here with us today to break this down. That was FA Corner, brought to you by Capital Group. Still with me for the hour, Jeremy Schwartz, WisdomTree Global Chief Investment Officer here. Would love to just get your final thoughts, especially as we round out the show here today and knowing some of the very pressing matters investors are wading through as we were breaking them down.
Yeah, when we started the show with geopolitics, the next few weeks are probably be choppy as we get through both the Iran issue, but then the tariff July 9th deadline. So I think as you get to July 8th, you want to be negotiating with Trump. I do think that 10% level is going to hold, and more people are going to come to that. But that's the number one issue, really, for the markets is the geopolitical angle, and we're trying to help provide unique solutions for all that. But the Fed, it'll be interesting. We do think they should be cutting. We'll see if Waller can influence Powell. I know he has Powell's ear, and so maybe we'll see if Waller can influence him and say July could be on the table.
Interesting. We will see what plays out there. A big thank you to Jeremy Schwartz of WisdomTree for joining me this hour. Good to see you.
Thanks so much, Brad.
Absolutely. Well, everyone, we've got much more coming up on Yahoo Finance today. Wealth dedicated to all of your personal finance needs. I've got you for the next hour. Stay tuned.